This is such a predicament of serious research. The latest quarterly outlook is just out. The dispatch titled, Dovish Fed and Stabilizing Profits Drive Markets Higher. At the heart of this case, what we're arguing is that fundamentally the profit cycle is bottoming. We're looking at estimates that are starting to reverse course. And on top of that, the Fed is coming in a much more dovish fashion. If this is correct and we end up seeing short rates getting cut further into the back half of this year, that can only ignite some of the current trends more aggressively. If we take a look at a couple of the key fundamental drivers of what's going on here, to the left is a look at high yield credit spreads. What you're looking at is the broad market, that's in blue. And in addition to that, you're looking at some of the more cyclical components, such as building materials, banks, and thrifts. At the heart of this, what this is saying is risky assets, risky businesses are getting record low credit access. And so what we take this to mean is that the market's already moving on the assumption that we have a much easier credit backdrop in the making. What does that do for the profit cycle if you fast forward 2-3 quarters? Take a look at where we're at right now. Top line growth has been slowing for the last couple of years thanks to the tightening. Estimates are on the mend. What this is telling us is you're going to get an acceleration fundamentally for businesses. That's a good thing for stock prices. Importantly, though, this is the conundrum in the moment, and this is the challenge for active managers, which is if this is correct, what we're also seeing right now is this massive AI run. To the left is a representation of the FANG-related stocks, this Nifty 7, the MAG 7, as some call. That outperformance versus the market is pretty stunning in the last year and a half. To the right, however, is something that's also underway, which is this sort of Ozempic miracle. So stocks like Lilly and Novo are also on a tear. Our belief here is that this speculative run that seems really long in the tooth may continue just because of the headline news that's so favorable. Importantly, the speculative run may broaden further. While we believe the market is already very crowded, risk appetites could actually get a lot frothier before this is done. Take a look at our risk appetite reading. This model currently hangs in sort of long-term averages. It has begun to climb, and we suspect this will climb further. But really, we begin to worry when we get into this unusual north of one standard deviation terrain. So we're not there. And so I suspect markets could get a lot frothier before this turns. Ultimately, though, we like this fundamental backdrop. We think paying attention to valuations, sector exposures matter a lot because of what's going on. Bottoms-up leadership is likely to broaden, and that's very good news. To sort of back this up, our style oscillator is now squarely in a buy value zone. Uncomfortable given the fact that everyone's chasing NVIDIA right now. But the reality is that if the profit cycle's bottoming and growth begins to rebound and we get an easier Fed, we are also going to look for not just where to find growth, but at what price growth. And that's more of a valuation-sensitive market we're likely going into. I think first thing first, though, we do need to price in the good news. The speculation will probably climb further before it really starts to subside. With any questions, please feel free to reach out to us. Thank you.